The era of American market dominance is over. For nearly 15 years, the prevailing investment thesis was singular: US exceptionalism. This era was characterized by the outperformance of US mega-cap technology stocks, a relentlessly strengthening US dollar, and superior American earnings growth relative to the rest of the world. But right now, we are confronting a structural inflection point. The global financial order entering 2026 is defined by a fundamental fracture in the market narrative that has dominated the last decade. Welcome to Coffee Break Capital. Financial markets move fast, but we move faster. Sit down, take a sip, and let's get you caught up on the numbers that matter today. Let's start with the bearish side of the tape, focusing on the heavy headwinds facing US-centric portfolios. As we enter 2026, the global equity market is characterized by a historic bifurcation in valuation, driven largely by the Magnificent Seven and the initial wave of AI enthusiasm. The S&P 500 trades at a forward price-to-earnings multiple significantly exceeding its long-term average, hovering near 21 times. This valuation leaves little margin for error. It implicitly forecasts not just soft landings, but an acceleration of earnings growth that defies the typical late-cycle dynamics of an economy facing high interest rates. Furthermore, for the past decade, the US dollar has acted as a wrecking ball for international returns. A strengthening dollar reduces the returns of foreign assets when translated back into US dollars, creating a currency drag. However, the trajectory of the dollar has shifted. We are witnessing the early stages of a secular bear market for the US dollar, driven by the convergence of interest rates and the growing concern over US fiscal profligacy. If you want to survive this massive capital rotation and keep your portfolio ahead of the curve, pause this video and hit that subscribe button right now. Now let's pivot to the bullish narrative. The 2026 investment landscape is the maturation of a great divergence, where the risk-reward symmetry has decisively shifted in favor of international markets. This rotation is moving money into the deep value markets of the developed world and the high growth engines of the emerging world. For investors looking beyond broad index funds, 2026 offers 5 high conviction, single country growth stories. First, we have India, which is widely regarded as the best structural growth story in the world for the next decade. India is replicating the infrastructure-led growth model of China, but combining it with a unique digital public infrastructure that has financialized the economy rapidly. Their Make in India initiative is attracting billions in manufacturing foreign direct investment. Because of this boom, earnings growth for the Nifty 50 is projected at roughly 15 to 16%, the highest among major economies. Second is Vietnam, the most compelling event-driven opportunity in 2026. Vietnam is the primary beneficiary of manufacturing relocating from China. But the massive catalyst here is that FTSE Russell has placed Vietnam on the watch list for reclassification from frontier to secondary emerging market status, expected in September 2026. This upgrade forces passive funds tracking emerging market indices to buy Vietnamese stocks, creating billions in guaranteed inflows. Third on the list is Indonesia, the EV supply chain sovereign. Indonesia holds the world's largest reserves of nickel, which is required to build EV batteries. The government actually banned raw ore exports to force foreign companies to build smelters and battery factories domestically. This downstreaming policy has been wildly successful, attracting massive investment from Chinese and Korean battery firms. Fourth, we look to Brazil, the real rate king. Brazil is an agricultural and mineral superpower, supplying the world with soy, iron ore, and oil. In 2026, Brazil offers some of the highest real interest rates in the world, attracting foreign capital which supports the currency. Meanwhile, the equity market trades at distressed valuations of roughly 7 to 8 times earnings. Any stabilization in their fiscal policy could trigger a massive re-rating. Finally, the fifth country is Saudi Arabia, which is undergoing the Vision 2030 transformation. Under this vision, the kingdom is spending trillions to diversify into tourism, entertainment, technology, and finance. they are successfully decoupling their equity market from the price of oil. The stock market is dominated by the banks funding these massive giga-projects, offering a unique growth path entirely separate from Western tech stocks. When we look at institutional predictions for the years ahead, Vanguard's long-term capital markets model projects U.S. equity annualized returns of only 4 to 6% over the next decade, compared to 7 to 9% for international equities. The data suggests that the Great Divergence is not a fleeting moment, but a structural pivot. The safest, most actionable step you can take today is to review your portfolio to ensure you aren't heavily overexposed to just US stocks. Consider shifting some capital into these structural growth engines using targeted country ETFs like INDA for India or VNM for Vietnam. This information was compiled from various sources across the internet and is not intended as financial advice.